Hi, I am Mike Ward, and I want to talk to you about the implied terminal growth rate in the discounted cash flow formula for valuing companies. Now, if you know anything about finance and valuation, you will know that the preferred method for valuing companies is not what the accountants say, which is what's found on the balance sheet here, the net assets. Those are based on historical cost typically. What we're interested in is what these assets can generate into the future in terms of actual cash flow. So we measure the free cash flow, which is the cash flow from operations, but minus any investment that we need to make to keep the company going in the balance sheet. So it's minus the capex and minus the increase in working capital and so on. So we call that free cash flow, and we discount this into the future and we add it up. Now, typically we can forecast maybe 5 years accurately, some cases less, in some cases we need to go more. But most companies last longer than 5 years. And so what we're really concerned about is this little circle at the end here, which we refer to as the terminal value. Now, here's an example. Let's say for the average company, you forecasted just 5 years and you discounted this by what we call the WACC, the required return by investors, weighted average cost of capital. That might represent about 30% of the value that you see represented on the stock market. The rest, the 70%, is sitting in the tail. So this is not a trivial problem. Now, one way to solve this is to do more forecasts. Now, we try to do that. If you can forecast, say, for 10 years, the free cash flow, well, that will then obviously represent a higher proportion, let's say 60% of the value, and 40% will be residing in the terminal value. So we should try to forecast as many cash flows as we can. And certainly when a business is growing and it's in the growth phase of its life, we have to try and forecast more, because the terminal value, we tend to use a constant growth rate, and therein lies the problem. So if you look at research that's been done, you'll see, for example, and this is quite old, but they're saying only about 12% of the actual share value, that's the price, the value, market cap, if you like, of Fortune 500 shares, could be accounted for by dividends over the next 5 years. Now, we're not really focusing on dividends, we're looking at free cash flow, but you can see a large proportion is beyond the 5 years. Here's another study on the Dow Jones 30 shares, and they're saying that if you look for 10 years, and you find that only represents about 40%, slightly over 40% of the value that's shown on the market cap. So we've got a big problem here. If you look at textbooks, you're going to find this type of quote. The terminal growth rate must be less than GDP plus inflation. If this is not the case, then the value of the company will eventually exceed the value of the world. So there's strong pressure here to, argue that companies cannot grow faster than GDP. But is that true? Does GDP really set the limit? Well, GDP is not a measure of growth in corporate cash flows. GDP, as you know, is made up of consumption, government expenditure, investments, net exports, imports over exports, and so on. And it focuses on current expenditure, which is very different to what we are talking about in terms of value for shares. For example, the share price of Nestle, say, reflects future growth in India and China, and it's not captured in the GDP of Switzerland. So we've got to be careful about this. GDP, if you look in Wikipedia, is not a complete measure of economic activity. It accounts for value added at each stage of production, but not total output or sales along the entire production process. It deliberately leaves out business-to-business transactions in the early and intermediate stages of production, as well as sales of used goods. So why are we looking at GDP? It doesn't really relate. Now, let's look empirically. Can equity returns actually beat GDP? Well, if you go to the US, since 1871, so we're talking about 150 years of data here, annualized real, that means with excluding inflation, returns from US equities have been about 6.2%. versus US GDP, which has been about 2%. Real, that's real. So what we're seeing here is that, yes, the actual returns of US equities have done about 6% on average versus 2%. That is not a trivial difference. That is 3 times the faster growth rate in shares than what we're seeing in GDP. And that's for over 150 years. So that's the fact. Now, of course, if we drill down a little bit, we have to be a bit careful, because if you look at price indices like the S&P 500, that excludes dividends. So price appreciation only represents about 2%, which is what we see GDP doing. And the rest is from the reinvested dividends. Just to show how big a deal this is, in South Africa, for example, 90% of the equity value of a lump sum investment made in 1960 comes from dividends. So if you put 1,000 Rand into the stock market in 1960, the value of your portfolio now would be, well, 90% of it would have come from the reinvested dividends, not from the growth in the index. So we've got to look at what we call total returns here. Now, if you look at, take a South African perspective here, and you look at perhaps the most common textbook that's used in finance, all it says about this very important topic is that G must be modest. And they give an example of G being about 5%. If you compare that to the actual returns that investors have had on the JSE, for example, since 1960, and these are total returns, including dividends, in other words, you can see that the average has been about 17%. So shareholders have been getting, on average, 17% for 50 years. Why are we using 5%? It just is a big difference. If we look at the S&P 500, and this is just some data from the FT here, going back about 25 years here, you can see that they're showing you an index of sales per share, and then they've got the earnings per share and the index price per share. And what we expect to see is that the earnings and the index kind of linked together, because there can't be a real difference between prices that people are getting for their investing in shares and the earnings. And if you work it out, you can see it works out. It's kind of not smooth, but the average is about 8% per annum. That is what we've seen earnings grow at on the S&P 500, and also prices. So you'll be familiar with the price to earnings ratio on the S&P. And this is data from Schiller going back to 1870. So we're looking at a lot of data, 150 years. And what we know is that this is a stationary series. In other words, it doesn't consistently go up or down, because the price of a share is related to the earnings of the share. Now, there are times when it gets a bit out of kilter and the PE ratio is extraordinarily high, like nearly 45 here, and then, of course, the market crashes. So investors watch this. The time to buy shares is when the market is down, prices are cheap, and the PEs are low, not when PEs are high. So we expect there to be a relationship between the price of a share and the earnings of a share. And so if we look at actual data and we look at what's been happening on the London Stock Exchange over the last 20 years, we're going to take the top 100 companies on the London Stock Exchange, and we're going to estimate backwards the implied terminal growth rate. Now, to do this, we're going to, first of all, let me give you a picture of what we're going to do. We can go back in time. Let's say we go back 6 years. We're actually going to go back 10 years. But if we were to go back 6 years, we would know the actual free cash flows for 6 years. We can go and see what they actually were. And we also know what the company was worth 6 years ago. And so if we know all of that, we can solve for G. So just putting it into algebra here, the value of a company, the debt plus its market cap, is equal to the discounted free cash flows over the first 5 years, plus the free cash flow in year 6, which is going to grow by G. That's the key thing here. And then we need to discount this, treat it as a perpetuity first here, and then discount it by 5 years. That's our formula. And then we mustn't neglect excess cash and investments as well, which need to be added to this side of the equation, if you like. So if we solve for G, we can get a formula for this. That means if we know what the WACC is, we know what the market cap was and the debt was 6 years ago, we know what the actual free cash flows were, we know how much cash and investments they had on their balance sheet, we can solve backwards and work out what the implied growth rate was that shareholders were actually pricing into the share back then. So we're taking the top 100 companies, we're going to go back 20 years actually, and that covers the crash of 2008. We're getting our data from Thomson Reuters, and the things we need are the market cap of the company each year, total debt, end of each year, free cash flow each year, and we are going to estimate the weighted average cost of capital ourselves. Now we're going to take actually the first 10 years because we're trying to get as many actual free cash flows as we can to push this portion of the value to be as low as we can. And so we're going to discount these since we know what WACC is, and then if this is 2018, for example, we need to go back here 10 years to 2008, and we look up the market cap, and we also add the debt and cash and any investments to this, and then we estimate here G. We know what the free cash flow is in year 10. We can solve backwards to work out what G is. So here we are doing it. I've just put the formula at the top here so you can see what we're doing. And you can see, for example, we've actually done this for 10 years because we've got sort of overlapping 10 years of data here. So this last one here, for example, is giving us an implied G of about 5.1%. That is taking these 10 cash flows over here, and then we know what, this is for BP, just by example, we know what the actual market cap of BP was then, how much debt it had, and so on. And we are solving to get this back based on its actual free cash flow. Here you can see us working out the cost of equity and the risk-free rates and so on here. And if we take the median of the implied Gs for BP over the first 10 years of the data here, because this is overlapping data, albeit, we get 9.1. So we're going to do that for the top 100 companies. And of course, there are a few caveats. We're using the capital asset pricing model to estimate WACC. And we put in a 5% market risk premium here. And there are some issues with this. And then, of course, the free cash flow in year 10 is pretty critical because it is what we grow to get the terminal value. So to try and get rid of some of the volatility, we are going to use medians rather than averages to get rid of sort of outliers. And we're going to take 10 years to get of actual free cash flows before we do the solving for G. That diminishes the contribution of the terminal value to the actual value, but it also reduces our sample size because not every company has lasted for 20 years. And so, of course, there is also some survivor bias in our data. So here are our results. You can see that the median implied growth rate was 6.3%. The average was about 5%. We lost 13 companies. 23 companies in the data that hadn't been around for the full 20 years. So there is some survivorship bias here. But these kind of numbers here are much higher than what GDP was. So using the last 10 years of free cash flows, using the company's actual WACC, and there are some issues with this, knowing the value of the company 10 years before all of this, we solve for G. We've got 77 companies in the data. We get an average of 4.9, let's call it 5%, lots of outliers in the data, and the median of 6.3. That gets rid of outliers or tries to smooth for them. And if you look at the actual GDP growth rate in the UK, well, since 1955 to 2020, so we're not exactly overlapping perfectly here, but it's 0.5%. We're getting answers of 5% here. So, you know, it's suggesting to us that actually the terminal growth rate is higher than is believed, probably quite a bit higher than GDP. Let's say about 5% on the London Stock Exchange. It would be better to forecast more years in the near term. That way, the proportion of value that's sitting in the terminal value is always lower. So we suggest people go as far as they can. But perhaps we should also bear in mind that the important metric is actually WACC minus G. And if we look at our data, that should be around about 3%. And so we need to be consistent with that. And finally, we should always benchmark the terminal value using some other methodology because it is pretty volatile and it does represent a large portion of the value. So we're recommending using multiples to do that. I hope you found that useful.